From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for January 23rd, 2026. Let's see what's happening. The Frosty 5K this Saturday at the Waukesha Jamboree has been canceled because it's just too frosty. You might want to call ahead for any outdoor activities this weekend to see if you're still on. Thank goodness for the Bucks. They're home and indoors. Tonight at Fiserv with the Denver Nuggets and Sunday with the Dallas Mavericks. The Milwaukee Admirals are home Saturday with Iowa Wild at the Panther Arena. All right, here we go. Tech startup company GRU plans to put a hotel on the moon by 2032. They're testing inflatable dwellings for multi-day visits. So what can you do on your moon vacation? Well, there's always moonwalks in the moonlight, which is always on, moon buggy trips, or driving a golf ball farther than you ever have in your life. And because the moon is weak, gravity, you only weigh 1/6 of your earthbound weight. So hold my is epic. A man robbed Wells Fargo Bank in Utah. He handed the teller a note demanding $1,000. When the teller gave him $140 from the drawer, the robber left. And then he headed down the street to a restaurant. Well, he's had a busy morning, so he's probably hungry. There he ordered lunch. His bill was less than $20, and he left the rest of the cash as a tip, a $120 tip. You get a couple of those weeks put together, and you got a pretty good month going. And finally, a recent study suggests that the urge to mate, as we used to call it, the urge to merge, overrides the need for sleep in male fruit flies. Research says there are situations where these sexually aroused fruit flies can stay wide awake and on the prowl without the need of sleep for as long as 5 or 6 days. Just reading this made me drowsy. On the podcast today, we have Dave Sandstrom, Mike Hoelzl, Joel Driesing, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Max. Those fruit flies probably not too happy outside right now, given the temperature. Markets seem to be following along with the falling temperatures. The NASDAQ down 0.1% this week, down 14 points. The S&P down 24 points. That's 0.4%. And the Dow Jones Industrial Average, after losing 285 points on Friday, down 261 for the week. That's 0.5% for the year. NASDAQ still up 1.1%, S&P up 1%, and the Dow Jones Industrial Average up 2.2%. You know, Dave, pretty hard not to point to Tuesday and a big market response. We saw expectations for continued escalation with respect to Greenland as Trump prepared for a speech at Davos. And then all of a sudden, shortly after, we seem to have reached some kind of deal. We had announced all these tariffs on Europe. We turned around and pulled all those tariffs back. And the market saw some wild swings in the span of really just 24 hours, really across 2 trading days. What kind of takeaways do you have from the markets this week, other than maybe just hold on to your hats for a little while, because I think we're back in one of those environments in which maybe the headlines might be driving investors crazy again?
It gives me visions of a broken record, Kyle. I mean, this goes right back to the original tariff announcement on April 1st of last year. We saw a significant slide in the S&P, almost a 20% drop in 2 days, only to see the markets recover very quickly based on the president walking back those tariffs. So, again, kind of a broken record this week with the same type of thing. And I think that theme even goes a little bit further. I think we've spent an awful lot of time here in the last 12 months talking about stocks being expensive, economic activity being resilient, not booming. We've seen labor markets softening, but doing pretty well. And it's just been that kind of consistent theme across the board. So not too surprised to see the volatility this week given what that headline news was. But I have to say those underlying things I just discussed, the economy's strong, the labor market's strong. I think there's reasons to be optimistic.
Yeah, certainly there are, and some signs that maybe the rest of the world continues to sour a bit on the U.S. We saw biggest decline for the dollar since May of last year this week, and some overall maybe pessimism more broadly. And yet, to your point, it comes amidst all of these really positive developments. And I think it's a reminder for investors, Mike, perhaps that even when we know the bad news, even when we know the timing of the bad news, that sometimes you just have to wait a day and it might turn back around the other direction. And I think perhaps it speaks to the way we choose to allocate portfolios, right? And so what are you telling clients at a time like Tuesday in which, well, yeah, we're down almost 3% at one point. But again, maybe just hold on to your hats and let's see what comes next.
Well, first thing I thought, with everyone talking about Greenland, I thought they were talking about the 2020 action movie starring Gerard Butler, where the end of the world, aptly titled Greenland, where you had to get to Greenland to save your own life. I'm just saying, if you haven't seen it, folks, check it out. It's really not worth your time, but it's kind of fun. So to get to your question, Kyle, now that I've stalled long enough, is with balanced portfolios, it really works in kind of in the era that we're in right now, where it seems the markets move faster than ever, the news coming out moves faster than ever. 1 minute, again, just this week alone, as Dave mentioned, it was very reminiscent of last year with Liberation Day, where you're seeing this very strong language about Greenland and tariffs to Europe and this, that, and the other. Sorry, I didn't want to do yada, yada, yada like Seinfeld. But then the very next day, it's a complete reversal, right? And so if you have a balanced portfolio, it allows you to not constantly be chasing, to not constantly be trying to keep up with the headlines, because no matter what happens in those headlines, some piece of your portfolio is most likely going to react pretty positively, right? And so it's the people that get like the polar opposites on one, either all stock or too defensive with all bonds or cash, that if you're in those sectors, you're going to be chasing one thing or another. And usually the second the headline comes out that you're going to trade on, you're already too late.
Yeah, you're behind, right? And so I think the interesting part for so many investors is there's this desire to constantly be in the best asset class, the best stock, the best whatever. And the reality is that if you're waiting to find out what the best one is, you're probably already behind the curve, Mike, as you point out. And Dave, I think nothing more obvious than just looking at maybe the returns of the Magnificent Seven or some of the big tech stocks going back the last few years. We've seen slowly now the rest of the market start to catch up, and a much more broad return series looking back last year and even as we start this year than just a small number of names.
Kyle, you look back at 2023, we saw literally record-breaking performances from 7 companies, taking on just a huge majority of the returns in the market. And I think it's one of those situations where it's very tempting for investors to maybe get out of balance, as Mike is talking about, and saying, you know what, I need to have half my portfolio in NVIDIA and Amazon and Tesla and whatnot. And that's a tough thing to avoid, because as fast as those companies have moved up, we've seen them also come back to earth at times. So I think it's encouraging for investors like us that are looking for balance and looking for stability to see a year like last year, in which those 7 companies were much more in line with the rest of the S&P. And I think the broad participation speaks, I think, to an economy now that is kind of moving forward as a much larger group and not just those 7 companies.
And what's interesting is that those few companies are still spending piles of cash. You and I were talking before the show earlier today about just how much money is being spent in that artificial intelligence space and technology more broadly, and yet it feels like we've gotten to a point where that spending is benefiting now not just the few companies that were initially putting the money to work, but actually now making its way into the rest of the world in massive productivity gains and kind of this innovation that I think, as we've talked about on the show in the past, as we've talked about, drives kind of this period of time in which there are these immense potential for economic gains, but also market returns. I don't know of a better reason to be excited about stocks long term than just the pure amount of cash that's being spent making businesses more profitable.
And I think the thing that makes this markedly different, Kyle, is in the past, tech companies were known for plowing all of their profits back into the company to make it bigger. But a lot of times that money was spent on buying talent, research and development, buying other companies. We're talking now about trillions, literally trillions of dollars being spent on physical infrastructure in the United States economy. Data centers, work on electrical grids, power systems. These are types of expenditures that are benefiting what I call Main Street USA. You're talking about electricians, plumbers, contractors, truck drivers that are going to be benefiting immensely on the front end of this thing. And I don't think you can just ignore trillions of dollars being plowed into infrastructure. It's going to have a positive effect on economic activity.
Well, and it's going to create jobs even if it destroys them in other places, right? And so that's been the history of innovation, is that we do displace workers as we innovate away from certain roles. And historically, that was maybe moving people off of the farms and into the production lines and off the production lines and into the main office. And now maybe it's moving people back away from their computers and back into getting their hands on things, because, again, it's really hard to do that fine detail work that's necessary for the electricians, for the plumbers, without at least some human oversight, without at least some human input. And so it's why we're seeing so much more investment, I think, in the early days of education now in some of those core trades. It's not an all or nothing trade-off. Certainly there are plenty of places that we're going to need other types of labor, other types of input, but I do think it's a good reflection of how we find the opportunities in the future, when the concern is always, well, what are people going to do when they don't need to be doing data crunching anymore, when they don't need to be coding anymore? Well, we'll find something else. Joel, it's an interesting time of year in which normally when we look at the economic data, especially coming out of winter, we tend to be pointing to the rough days that maybe led to some unexpected sales on the consumer side, a few days in which people weren't buying cars because it was too cold, maybe today and tomorrow. And yet we're still kind of looking back to late last year with most of the economic data to get a sense of where are we. And I think, again, it's not to sound like the broken record, but it's more of the same. The economy in some ways looks really strong. You look at the GDP number, for example, and maybe that's where to start. And in other ways, we're seeing some things that are not quite as strong as we hope. So what did we learn this week, which, again, looking back at what's going on a month, 2 months, sometimes 3 months ago?
Very briefly, I'd say it's more of the same. That's what we're seeing. And to Dave's point on the economic resilience, that's what we saw with the GDP numbers. For the third quarter, we saw a 4.4% annual increase in the U.S. economy. That's a pretty good pace. That was up from 3.8% in February. It's also up from a 4.3% estimate earlier for the third quarter. But the other thing about all the data that we're seeing now is we're still catching up from data that we were missing when the government was shut down in October and then, a week or two into November. And so a lot of the data we're getting is older stuff. We should be starting to look at fourth quarter numbers by now, and we're still looking at third quarter number. A lot of the numbers we saw this week were from October, for Pete's sake. So it's hard to sort of make sense to say this is what the economy is doing now when we're looking at numbers from 3-4 months ago. But the GDP number looked good, and it showed that consumer spending is still strong, although it was a little weaker than it was in the first estimate. We had better investments from businesses, as we were just discussing. The government was spending more. The exports were up, which was good. Imports were down. There's still sort of a balancing out that's coming from the earlier in the year companies stocking up things so that they didn't have to import them and pay all those tariffs. And so that's still going to be a while before we see all of the effects of that. But overall, it's good, resilient numbers. We also had the IMF, the International Monetary Fund. this week came out with its forecast for 2026 and thought that the U.S. economy would be a little bit better in 2026 than it was in 2023. So that's encouraging. At the same time, we had numbers today from the Conference Board, a U.S. business research outfit that thinks that the economy is going to be slowing in 2026, and that's based on their look at economic indicators, many of which are, again, older numbers, but they're seeing some drag on the economy, but it's not dragging as much as it was 6 months before that.
And I think a lot of that continues to revolve around some uncertainty over trade policies, some uncertainty over the reshoring of certain critical manufacturing. There are all kinds of things still up in the air that could mean massive shifts to the positive or potentially shifts to the negative. And so I think it is clear that the more opportunity we have to get answers on those questions, whether it's a Supreme Court decision on tariffs, whether it's what policies come out of some of those negotiations, the easier it's going to be to nail down those forecasts. And of course, part of that challenge is we're still dealing with not having all the old data, let alone being able to get all the new data in enough time to adjust. And yet, consumers, we have a consumer sentiment number this week, are looking at least what they can gather and trying to figure out, okay, where's it going to go? They tend not to be, on average, terribly well informed, but their general opinions do shape how our economy evolves.
Yeah, I don't know exactly who looks at those consumer sentiment numbers, the consumer confidence numbers. As you say, it's not hard science. It's not empirical data. It's more how people feel about stuff. And there's the belief that if people aren't feeling good about the economy, if they're feeling that prices are too high, that's going to affect their purchasing power, which is what we're seeing from these surveys, that's going to hold back the economy because we rely so much on consumer spending. And yet, when we see the numbers from the GDP report, we had another report from the Bureau of Economic Analysis on consumer spending, and it's still pretty strong. We had numbers last week on retail spending. It's still pretty strong, even though there are these harsh feelings about inflation and what that's going to be doing for future spending.
You know, I think it's just a reflection of an area that our country continues to lead in, and that's our ability to spend money. There is no doubt that there is an immense amount of cash still out there. There's an immense amount of wealth to be spent. And as I joke, there's one thing we do better than just about any other country on earth, and that's find ways to spend that money. And so I think it rings true of some of the demographic shift we've talked about, that we have more senior members of our country now that have more ability to spend, that have more incomes that are at least more stable than they were in their earlier years when they counted on employment more for their income. And so I think it speaks to, even if I'm not feeling quite as good as I used to feel about where things are headed, even if my overall sentiment isn't quite what it was, well, I'm still going to spend that money because I've been counting on spending it for all of my working years. And so,
I'm sorry, and we had numbers this week on housing too, and that's something we discuss a lot because that's a really big expense for most families. And the story there is still mixed. We had building construction spending for October and pending home sales. We said last week, and it was further evidence in this pending home sales report from the National Association of Realtors, that home sales are like at a 30-year low. Part of it is because there aren't enough houses. Part of it is because the disparity in mortgage rates, people who have lower interest rates don't really have an incentive to move and vacate the houses that new home buyers could move into. What I'm looking for from those numbers are a couple of months, maybe more than that, of good news. Even mixed news isn't really telling me yet that we've cleared anything there, and I think it's going to take a lot. I think it's going to take time, probably for more houses to appear before that's moved.
Joe, there was an interesting article this week in the Wall Street Journal talking about the conundrum we're faced with new buyers really looking for a price decline to benefit them, but the cost that would come to the rest of the homeowners if housing prices were to drop drastically. So it's a two-sided coin here. It's not just is not a win-win if housing prices drop. So what they'd like to see is affordability come through decreased mortgage rates and increased wages, not so much that we get a massive drop in housing prices. So we're in a tough spot as it relates to that situation.
Dave, that was such an interesting article because I think it highlights a big part of the problem that so many are happy with the price they paid for their home. They're looking at the rest of the market and going, I'm really not interested in moving at these prices. My house is good enough. And for those that are interested in moving, now they have that problem of, well, I can't afford the home you want to sell me for the price you want to sell it to me at, and you're not interested in selling at that lower price. And so lower mortgage rates certainly can help that problem. It can help to grease the wheels a little bit. But I think the other thing, Joel, you hit on a bit was perhaps a little more inventory. Overall new home construction might help to free up some more opportunity without completely knocking down prices, but it's about building the right kind of homes, building them in the right areas, building them for the right price, because ultimately that leads to the ability to generate more household formation. It leads to the kind of consumer spending on big ticket items, fridges and freezers and ovens that ultimately really help boost the economy in short order.
On a more practical level, I also read an article this week from the Center for Retirement Research at Boston College. They found that older homeowners tend to get less value when they sell their houses. And it's two things, then, if you think about it, they're pretty sensical. One is that people don't take care of their houses when they get older, and the other is that it's usually a desperate move, or a lot of times it's a desperate move, so they're selling it to the first person to come along. So that's just maybe something to keep in mind as you get older, or as you're watching people around you get older, to make sure they keep that up.
Well, that's one of the things that's happened in my neighborhood, actually. It's been a shift of kind of older homeowners to kind of younger. I'm not going to call myself young, but at the same time, younger people are coming in. And we do what everyone does. If you see a house go up on the market, you automatically look it up online and see what it's all about. And one of the things we've been seeing is if you buy the house, it looks like it's still from like 1987. And so in that calculus of, okay, we might be able to afford the house, but now we have to put all this money in to update it because I don't want to look like I'm on the set of like an old MTV studio or something like that, right? Like, so I think that's another problem that you hit on, that I know for a fact that some people I've talked to in my neighborhood, they thought about buying the house, but they're like, well, we can afford it, but now here comes another 20, 30, 40, 50,000 in remodel that we can't, and we don't want to sit in this house as is.
And I think this speaks to a conversation we were having last week as well about the potential inheritance that comes from this massive real estate market that's out there, the number of more senior citizens in our country that have a cottage and a home here in Milwaukee and maybe one down in Phoenix or in Orlando area. Well, yeah, you maybe aren't going to need 3 homes later in life, and so maybe there is some inventory free up that comes from that as well. Certainly, I think all these play together into what has clearly been one of the bigger, I think, challenges facing our economy is how do we get affordable housing, but more importantly, how do we keep that market moving in a way that helps people to kind of continue to progress in terms of what is one of the biggest sources of wealth for so many, their home. With that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.